Okay, so recently I uploaded a reel visualizing Sydney house prices over the last 20 to 25 years. And one of the comments mentioned how 2021 was a year where house prices just suddenly exploded. And I wanted to discuss that a bit today, provide my rationale, my logic, my reasoning as to why home prices increased so much in that year, and give a little bit of insight into how our global monetary system responds to crises and what the short and long-term implications of that is. So if we think back to 2021, 2020, we can remember that there's the coronavirus pandemic. We have this health crisis, COVID-19, and governments start taking it very seriously from about March 2020. I believe the first couple of cases started at the end of 2019, but by March 2020, a lot of cases started to be reported globally, and government started to implement lockdowns. Travel became restricted, and governments just wanted to make sure that they could control the spread of the virus. We were really unsure about how deadly this virus could be, what were going to be the impacts of that. Obviously, making everyone isolate at home, that obviously forces business activity to slow down. It forces the whole global economy to slow down, right? And there's nothing you can really do about that if you want to prevent people from interacting with each other. And obviously this flows into certain industries, right? So certain industries like the airline industry, travel, tourism, these industries are impacted quite severely. There's also another problem that COVID-19 creates. If we think about the world, the whole world needs US dollars. The US dollar is the reserve currency of the world. And every country needs to have US dollars in order to settle trade. If you think about oil, if you think about energy, oil energy is settled in US dollars, South America, Canada. If you think about a majority of trade is settled in US dollars, the whole world just needs US dollars in order to settle all types of obligations. Now, when the coronavirus pandemic happens, companies, entities, anyone that needs US dollars, they're all a bit unsure about, well, am I going to be able to get US dollars in 3 to 6 months' time? Am I going to be able to borrow US dollars at the price that I can borrow them today? And companies, they want to get ahead of this. So at the start of the pandemic, basically companies all around the world, they try to get their hands on as many US dollars as they can. And this creates an old-fashioned bank run of sorts, right? We have a banking system crisis. Or a bank run. A bank run on US dollars. Obviously, COVID is it poses a systematic risk. And the private credit markets, or if you think Wall Street, City of London, the typical banks that will provide US dollars, that will lend US dollars out, they all become a bit risk off. They can't supply the amount of US dollars demanded. You have this huge demand shock. And in a situation like this, the Federal Reserve, or the central bank, I guess the Federal Reserve is the central bank of America. The central bank's role is to come in and be a lender of last resort. Lender of last resort. So they will come in and basically provide the liquidity in order to make sure that this spike in US dollars doesn't lead to a contraction in the global economy. They want to ensure that US dollars remain liquid, because if the private markets cannot provide this flow of US dollars, that can have cascading impacts on the entire global economy. If companies aren't able to borrow money or continue rolling over debt, if US dollars cannot continue to flow throughout the global economy, the global economy can just start to fall apart, right? People might start losing their jobs. Certain industries might just tank overnight. So central banks want to avoid that, right? They want to make sure that they can control inflation and they can control employment. And they want to ensure financial stability. So the Federal Reserve kind of becomes the central bank of the world. And what they do is they create these swap lines. So this is, I don't want to get too technical, but this is just an instrument or a tool that the Federal Reserve can use to push out US dollars. And what they do is they create these swap lines with other central banks around the world. So Japan, Australia's RBA, we have Bank of England over here, Canada. They provide US dollars. They lend these US dollars out, or they swap them with the other currencies, and that allows US dollars to flow this way, and then these countries can basically, their central banks can lend it out to whoever needs US dollars, and then that keeps US dollars flowing around in the world. So that kind of alleviates that issue. But it creates another problem. Banks domestically need to fund home loans, right? So if we think about, I'm in Australia, so in Australia, banks will need to provide credit. They'll need to provide credit to businesses. They love to provide credit to homeowners. They need to constantly be selling debt, right? And in order to fund these home loans, they get a certain percentage of funding from offshore markets. All right, so in Australia, 25% of all, let's say, home loans, business loans, domestic lending is kind of funded from overseas investors. All right, a majority will be funded through deposits and other means internally. There are the other instruments that they use, but 25% will be funded from overseas markets. So how does this work? How does this foreign money make its way into the Australian housing market? So say if I'm a bank like CBA. CBA is the biggest bank in Australia by far. Say if they want to lend out $1 billion in home loans. And there are some investors in Europe. And CBA goes to them and say, we want to borrow $1 billion. $1 billion. And we want to lend that out, and they'll create a bond. Right? So CBA will pay some fixed coupon amount every, say this is a 5-year bond. CBA will pay back, some interest every year, known as a coupon, and at maturity they'll pay the entire amount. But the European investors, they have euros, right? So obviously CBA needs to lend AUD into the domestic housing market. So they need to convert this euro, $1 billion worth of euros into AUD. So how do they do that? Well, they might go to an investment bank, think someone like JP Morgan, they'll go to basically Wall Street, and they'll say, look, we want to basically swap this $1 billion into AUD. So what JP Morgan will do is they will basically provide CBA with about, let's say, if you convert the 1 billion euros into AUD, let's say that's 1.6 billion AUD. And sorry, it should be the other way. If I just get rid of this. So say CBA will provide the 1 billion euros to JP Morgan. JP Morgan will provide 1.6 billion AUD. And CBA can then lend this 1.6 billion into the housing market. These people will obviously pay back interest on their home loans. And this interest, if I color this in red, so this interest will make its way back to JP Morgan, and the $1 billion that CBA lent to JP Morgan will pay back interest on this euro, and then that money will find its way back there. So this is called a cross-currency swap, I believe. See, swap. And I'm simplifying this quite a bit because this can get very complicated, but basically through an intermediary like JP Morgan, CBA is able to raise money in an international market. They're able to convert the currency, and they're able to lend that into the Australian market, and they do it through instruments like this. Investment bankers basically facilitate big trades like this. So 25% of housing debt is funded in this way, in this kind of way. And obviously because of COVID now, investors in Europe, they're like, we don't want to do this, right? We're a bit risk off right now. Investors are unsure, if I lend this $1 billion out, am I going to get it back in 3 to 6 months' time? There are less investors willing to lend at the at previous interest rates prior to COVID-19. So central banks, again, have to step in order to backstop this. So in Australia, our central bank is the Reserve Bank. It's basically the same pattern in all Western central banks. But our central bank came in and they were like, okay, well, we have to backstop, or we have to fill in that gap that banks usually get from foreign markets. So the RBA creates this thing called a term funding facility, right? A TFF. And the way that it worked is the RBA basically created $90 billion. $90 billion. And banks in Australia that were lending into the Australian markets, obviously you had your big four, but you also had a bunch of foreign banks that are lending in Australia. They all got access to a certain amount of this 90 billion, right? And the amount that you got was proportional to your size. So the big four, obviously they get big chunks. See, if you think CBA and stuff, but your smaller banks, they get They get smaller chunks. And each of these banks, CBA, ANZ, what have you, they have from March 2020 to June 2021 to withdraw from this $90 billion facility. Now, this is what it was originally, this is how it started off, but over the course of COVID, this facility was changed. So whilst it started off at 90 billion, and the cost of withdrawing from this facility was 0.25%. So for every dollar that banks took out of this, they had to pay 0.25%, and that was over a 3-year period, and that was fixed. Right? But I think by September or late 2021, this facility had doubled in size. So the Reserve Bank of Australia was basically ready to backstop the domestic banking sector with $188 billion worth of money, and they more than halved the cost of this money. So it was 0.1% over 3 years. So banks could take out of this facility, they had to pay it back, whatever money they took out, they had to pay back 0.1% interest over 3 years. Now, during 2020 was a really uncertain time, and there wasn't too much debt deployed. There was a significant amount of buying during 2020, but 2020 was really a year of like solving issues like, how are we going to create a virus? How are we going to create a vaccine? How are we going to distribute the vaccine? There were all these issues that had to be solved, and there was still a lot of uncertainty. But it wasn't until late 2020, 2021, when governments around the world felt like they had the situation somewhat under control. At least the health, the pandemic was somewhat under control. So a lot of banks had not pulled out of this facility straight away in 2020. But by 2021, once this window was closing, they realized that, 0.1% over 3 years fixed is probably going to be a lot cheaper than going to international markets to get this source of funding. The Reserve Bank has provided this funding. We might as well use it. So about banks started to really draw down on this facility heading into 2021. And in 2021 alone, about $144 billion went into the housing market. And for reference, before that, I believe the largest amount of credit that was injected into the housing market was roughly about 100 billion, right? So you have this huge jump in the amount of credit flowing into the housing market, right? The banking sector, obviously, so if I just take this here, if we have the TFF, 188 billion, right? You have this facility here. You have the banking sector here, all the banks. So this money flows this way at 0.1%. And then it flows through the real estate sector. So obviously real estate agents are responsible for kind of settling transactions. Any vendors, buyers, agents, that whole industry sees a massive boom because this money basically finds its way through there. In order to basically buy and sell a home, you need to go through these people. And it finds its way into the housing market, and you see one of the sharpest increases in housing prices. Sorry, you see one of the biggest booms in housing prices during this period. You basically have so much money pumped into the housing market in such a short period of time, that money has to flow somewhere, and it just causes existing house prices, to appreciate. So not a lot of productivity is created because of this, right? The money just has to go somewhere. There's only so many homes. You can't build homes fast enough. And that money just causes asset prices to explode, right? And this pattern, this way of basically central banks kind of coming in to backstop crises, this basically happened all around the world, right? So if you think New Zealand, Canada, America, England, right? They would have all done this in some sort of way. Maybe they didn't create a term funding facility the way that the Reserve Bank did, but they would have all done some sort of, they would have all provided basically like a subsidy to the banking sector to make sure that the banking sector doesn't fall apart during COVID. So I'll say that I think the Reserve Bank at the time, or central banks around the world, they just were trying to do what they thought was the right decision at the time. When the term funding facility was created in Australia, it actually had some good merit. The Central Bank of Australia actually created this with the intention of a lot of this money flowing into productive means. So they created some, and not explicit rules, but they said that for every dollar you lent out to small to medium businesses, banks could get an extra, I believe, $5 worth of funding. They could get more credit through this facility. And for every $1 that was lent to large businesses, they could get an extra dollar, so $2 worth of funding. So there was an incentive for credit to find its way into productive means. But unfortunately, a lot of it found its way into the housing market. Because whilst I think the main issue is that, you have this health crisis. You have this health crisis where people are forced to stay at home, people are forced to isolate. Given these conditions, it's very hard, I think, for banks to even lend to businesses. And the central banks, retrospectives, they've written plenty of articles about this. They themselves admit that it didn't really help business activity. And I think it's really hard because, how do you, central banks, they really only control the price of money, right? They control the price of money. But just because you control the price of money doesn't mean you can solve all of the world's problems, Just because you make money cheaper, that doesn't mean that you can suddenly spur about all of these businesses. And what has happened really in the last 10 to 15 years by making credit more cheaper is that credit has just flowed into assets, and that we've just experienced a lot of asset price inflation over the last 10 to 15 years. You have these shocks like COVID, and they really make asset prices go to places where nobody ever imagined that they could have gone to. And we are really still living with the consequences of that today. So that's my reasoning as to why home prices increased so much during COVID. I hope you learned a little bit about how central banks work and really what their role will be going forward. Because right now, Central banks all around the world, really our US dollar monetary system right now, it's under a lot of strain. It's being undermined by certain countries. Think Russia, think Iran. I'm not here to say, I'm just trying to be objective about this. This is the reality. These are the different players in the game. These are the different options that they have. And I think, finance, monetary systems, they are a constantly evolving thing. It is up to us in order to educate ourselves and understand how this space is constantly evolving, because sure, central banks come in and they're able to avoid catastrophe, but as a result, certain people benefit more than others. So obviously, since COVID, since all of this credit has flowed into housing markets, homeowners have benefited a lot. The real estate industry has benefited a lot. The banking sector has benefited a lot, because all of that money, in order to facilitate that activity, has to flow up and down the banking system, the real estate sector, and to homeowners. And obviously, if you're a kid, like say if you haven't even gone to university yet, you have to pay this enormous premium in order to buy a home for something that is not your fault, right? You didn't say that this should be the policy of central banks. No one even actually voted for this, right? I mean, if this was put to the public, would everyone agree with it? Are there better ways of trying to solve banking crises? I don't know. And we shall see, because I think there will be more significant crises on the horizon, and we shall see how central banks around the world respond to those crises. Comment below if you disagree, agree with my reasoning. Thanks.